In 1999, everyone knew the internet was going to change the world. They were right. But they were also spectacularly, catastrophically wrong about the money. Billions of dollars evaporated. Fortunes built over years, gone in months. The Nasdaq dropped 78%. It took 15 years to recover. Now look around you. Trillions of dollars are pouring into artificial intelligence. Nvidia has become one of the most valuable companies in human history. Every major corporation is racing to slap AI on their products, their earnings calls, their investor presentations. Sound familiar? Today, we're going to ask the question that Wall Street doesn't want you asking. Are we in an AI bubble? And if it pops, what happens to the rest of the market? 3 months after the Nasdaq closed at another record high, Marcus Chen sat in his Tribeca apartment, staring at spreadsheets that told a story Wall Street didn't want to hear. The former Google engineer had built his reputation on pattern recognition, first optimizing search algorithms, then spotting arbitrage opportunities that most traders missed. But this wasn't arbitrage. This was something much bigger and much more dangerous. Marcus pulled up the valuation multiples first. Most AI startups were trading in the 10x, 50x revenue multiple range, with the median typically falling around 20x, 30x. That alone wasn't unusual for high-growth tech. What caught his attention was how these multiples had become completely disconnected from mathematical reality. He started with OpenAI's numbers. Going from $4 billion to a $30 billion target in a single year would be unprecedented in enterprise software. Even hitting half that number would make OpenAI one of the fastest-scaling companies in business history. Yet OpenAI was valued at $850 billion, Anthropic at $380 billion, valuations that assumed not just hitting those targets, but sustaining impossible growth rates for years. Marcus had seen this math before. In 1999, he'd been a junior developer watching internet companies valued on eyeballs and clicks instead of profits. The difference was scale. Private funding for AI startups had topped $150 billion over the trailing 12 months, and the combined valuation of the 10 largest AI companies now exceeded $2 trillion. But it wasn't just the startups. Marcus tracked hyperscaler CapEx commitments. Microsoft, Meta, Alphabet, and Amazon had guided combined CapEx above $320 billion for 2026. Hyperscaler AI CapEx was on track to reach $725 billion in 2026. Every dollar was a bet that AI would generate returns that justified these astronomical investments. Marcus ran the numbers backwards. For these valuations to make sense, AI companies would need to capture a percentage of global GDP that had never been achieved by any technology in human history. The math simply didn't work, unless everyone buying these stocks believed they were getting out before reality hit. That's when Marcus realized he wasn't looking at an investment thesis. He was looking at the largest game of musical chairs ever played, with trillions of dollars at stake and not nearly enough chairs for everyone when the music stopped. Marcus's analysis revealed something even more disturbing than mathematical impossibility. The AI investment ecosystem had become a closed loop of circular financing that was inflating valuations across the entire stock market. Marcus tracked what he called the web, the interconnected deals between AI companies, their investors, and their suppliers that were creating artificial demand. He documented Nvidia investing $100 billion in OpenAI, even as OpenAI planned to buy more Nvidia chips. Meta had structured a $27 billion joint venture with Blue Owl Capital for the Hyperion data center, plus a $60 billion 5-year chip purchase agreement with Advanced Micro Devices, including an option to buy 10% of the business. These weren't traditional customer-supplier relationships. They were equity investments structured to guarantee revenue streams, a feedback loop Marcus recognized immediately. Company A invests in Company B, which uses that capital to buy products from Company A, which books the revenue and uses it to justify higher valuations, which enables more investment in Company B. The cycle perpetuates itself. Marcus pulled the numbers on venture capital flows. In 2025, AI firms had captured 61% of all VC investment globally, $258.7 billion of $427.1 billion total. Q1 2026 data showed $300 billion flowing into 6,000 startups. up 150% quarter over quarter. But Marcus realized these weren't independent bets. They were all nodes in the same circular web. The systemic danger became clear when Marcus mapped AI's dominance across the broader market. Since ChatGPT launched in November 2022, AI-related stocks had driven 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth. The top 20 companies now represented 52% of total market value, with the top 10 dominated by AI players. Every major tech company was simultaneously investor, investee, customer, supplier, creditor, and debtor in the same ecosystem. Marcus realized the circular financing had created a systemic dependency. The entire stock market was now betting that AI valuations would keep rising to justify the capex that generated the revenues that justified the valuations that enabled the circular financing. It wasn't a bubble in AI anymore. It was a structural risk that could collapse the entire technology sector, and potentially far beyond, when the mathematics finally caught up with the money. Based on Marcus's circular financing analysis, do you think the AI investment ecosystem is creating artificial demand, or are these valuations justified by future potential? Comment your answer below. Now let's see what happened when Marcus tried to warn Wall Street about what he discovered. By February 2026, Marcus had moved from analysis to action. The mathematical impossibility he'd uncovered wasn't just an academic exercise. It was a $2.3 billion short position against the entire AI ecosystem. Marcus structured his bet through a complex derivative strategy. He bought put options on the 4 companies that had collectively raised $188 billion in Q1 2026: OpenAI, Anthropic, xAI, and Waymo. But the real sophistication came in his index play. Marcus went long on individual AI stock volatility while simultaneously shorting the broader market volatility, a dispersion trade that would pay off massively if individual AI stocks crashed far more violently than the broader market indices. The strategy was elegant in its logic. When the AI bubble cracked, individual AI stocks would plunge harder than the S&P 500. If individual stocks proved more volatile than the broader index, the value of his single stock options would surge compared to the index options he'd sold. The math was on his side. Dispersion had already surged to its highest level on record in the US. Marcus's timing proved prescient. The first few weeks of February 2026 provided an ideal backdrop for these strategies. AI breakthroughs triggered sharp declines in companies considered obsolete and rallies in those seen as beneficiaries. The market was already beginning to separate winners from losers, but Marcus realized this was just the beginning. The position size reflected his conviction. At $2.3 billion, Marcus was betting more than most small countries' GDP that the AI investment ecosystem would collapse. He'd calculated the maximum downside, the cost of his options premiums, against the potential upside if his thesis proved correct. The risk-reward ratio was asymmetric in his favor, but only if he was right about the timing. Marcus watched the early market signals carefully. The professional trading community was beginning to notice the same patterns Marcus had identified months earlier, the divergence between AI winners and losers that his dispersion trade was designed to exploit. What Marcus didn't anticipate was how quickly the market would validate his thesis. By late February, the contrasting fortunes of AI winners and losers had kept the S&P 500 more or less flat, resulting in a bumper payday for dispersion traders. His position was already showing profits, but Marcus knew this was just the tremor before the earthquake. The real test would come when the circular financing web he'd mapped finally snapped under its own mathematical impossibility. 3 weeks after Marcus's position began paying off, the dominoes he'd predicted started falling exactly where it would hurt the most: in ordinary Americans' retirement accounts. Marcus tracked the exposure through what he called the silent pipeline, the chain of intermediaries that funneled pension money into AI investments without most savers even realizing it. He pulled the S&P 500 composition data. The 10 largest companies now accounted for roughly 40% of the entire index's weight, and every one of those companies was either an AI player directly or heavily dependent on AI spending for their growth. But Marcus realized the real exposure ran deeper than index funds. He studied JP Morgan's investment-grade index data and found that AI-linked companies would account for 14% of it in 2026, the index that passive bond portfolios and new pension mandates automatically bought into. Retirees weren't just exposed through their stock allocations. They were funding the AI bubble through their supposedly safe bond holdings too. Marcus examined the pension fund data with growing alarm. Tech companies had moved more than $120 billion of data center spending off their balance sheets using special-purpose vehicles, with Meta, xAI, Oracle, and CoreWeave all structuring deals through PIMCO, BlackRock, Apollo, Blue Owl Capital, and JP Morgan, the firms that managed money on behalf of pension funds, insurance companies, and retirement savers. He studied one deal in detail to understand the mechanism. Meta's $30 billion Hyperion data center in Louisiana was structured as investment-grade debt that looked safe to pension fund managers, earning an A-plus credit rating because Meta's creditworthiness propped up the structure through a residual value guarantee. But Marcus realized what the rating agencies had missed. The bond actually represented a bet that AI demand would grow without interruption for the next 15 to 20 years, that the hardware inside the building wouldn't become obsolete, and that Meta would honor a guarantee that could cost billions if things went wrong. The systemic risk became clear when Marcus mapped the full exposure. 57% of investors said that an AI crash was the biggest market risk in 2026, yet their own retirement savings were more exposed to AI than they realized. Even investors who didn't hold individual tech stocks were exposed through global index funds, which were increasingly dominated by large U.S. technology firms. Marcus reviewed research from JP Morgan showing that retail investors were piling into the chip market, which could signal the boom was headed for a bust. He recognized the pattern immediately. When retail investors started chasing the same trades as institutional money, it usually marked the final phase before a collapse. By early April, Marcus's dispersion trade was showing massive profits as individual AI stocks began diverging violently from broader market performance. But he wasn't celebrating. He was calculating how many millions of Americans were about to discover that their retirement security had been quietly wagered on the same mathematical impossibility he'd been betting against all along. By May 15, 2026, Marcus Chen's $2.3 billion dispersion trade had become an $8.7 billion position. The numbers on his screens told a story that even he hadn't fully anticipated. AI-related investment now accounted for half of GDP growth. A reversal would risk recession. Marcus had built his fortune betting against that very dependency, but now he understood what his analysis had truly uncovered. The entire American economy had become a single, massive AI bet disguised as a diversified market. His put options on individual AI stocks had generated returns of 340% as the dispersion between winners and losers exploded exactly as he'd predicted. But the real profits came from his volatility trades. When DeepSeek's launch in January caused Nvidia's shares to drop 17% in one day before recovering 8.8% the following day, Marcus's position captured profits on both the crash and the rebound. The mathematical impossibility he'd identified in February was now playing out in real time. OpenAI's valuation had more than tripled from $157 billion in October 2024 to $500 billion, but the company had committed to spending $1.4 trillion over 8 years building new data centers with just $13 billion in revenue, and had failed to present a reasonable roadmap to profitability. Marcus pulled up the concentration data. In late 2025, 30% of the U.S. S&P 500 and 20% of the MSCI World Index was held by the 5 largest companies, the greatest concentration in half a century. The S&P 500 was trading at 23 times forward earnings, and the Shiller price-to-earnings ratio for the U.S. market exceeded 40 for the first time since the dot-com crash. Marcus had proven that this level of AI investment was mathematically unsustainable, but he'd also proven something more disturbing. The entire financial system had become so dependent on AI valuations that even being right about the bubble might not matter if the collapse took everything else down with it. As Marcus looked at his $8.7 billion position, he realized he hadn't just bet against AI. He'd bet against the foundational assumption that modern markets could accurately price revolutionary technology. His profits were proof that the system was broken. But they were also proof that he was trapped inside that same broken system, hoping it would survive long enough for him to collect his winnings. Subscribe to Decoded, new episodes every 2 days. The money, the power, the systems they never explain.